In 1973, SWIFT launched and connected the world's banks. It took 3 to 5 business days to move money across borders. In 2026, your AI agent can draft a contract, negotiate terms, and execute a multi-step research workflow in 11 minutes. Then it hits a payment step and waits 3 to 5 business days. We have not moved. The reasoning layer of software advanced 50 years in 5. The financial layer did not move at all. Today, I am going to break down exactly what that gap costs, not in abstract terms, in real dollars, real failure modes, and real architectural explanations for why traditional finance cannot serve autonomous agents, no matter how many API wrappers you put on top of it. If you are building with AI agents, deploying agent workflows in production, or designing the infrastructure stack for autonomous systems, this video is the brief you need before you make a very expensive architectural mistake. Every piece of traditional financial infrastructure was built around one assumption: a human is at the center of every transaction. KYC, know your customer, assumes the customer is a person, a legal entity with a home country, a government ID, a tax number. Banks require a signatory, a human who accepts legal liability for the account. Payment processors require verified identities with billing addresses. Fraud detection systems flag behavior that deviates from human spending patterns, which means they flag agents constantly because agents do not spend like humans. Here is what this looks like in practice. You deploy a procurement agent. Its job: identify the cheapest API for a specific data task, purchase access, and route the output downstream. 22 steps. Steps 1 through 21 run clean. Step 22 is a $55 API purchase. The agent cannot complete it. No payment method, no account, no rails. A human steps in, completes the transaction manually, and the workflow continues. You just paid for a 22-step autonomous workflow. You got a 21-step automation with a human bottleneck at the end. That is not an edge case. In a survey of enterprise agent deployments, payment and financial action steps were the #1 cause of workflow interruption, ahead of hallucination, ahead of context limit failures, ahead of tool calling errors. The infrastructure assumption at the foundation of global finance is the load-bearing wall that breaks every agent workflow. You cannot retrofit around it. You have to replace it. Let me give you 5 concrete failure modes and what each one actually costs. Your agent executes a contract with a freelance researcher. Work delivered, $430 owed. You wrote that payment through ACH, 2 to 3 business days. Your researcher is in Indonesia. Add SWIFT fees. Add currency conversion spread. The researcher receives $387 4 days later. The agent completed its task in real time. The money moved at 1973 speeds. The arbitrage between agent execution speed and financial settlement speed is where value leaks. Stripe operates in 46 countries. PayPal's agent-accessible APIs are effectively limited to OECD markets. If your agent is executing work that involves vendors, contractors, or services outside those geographies, you have no rails. None. This is not a minor coverage gap. 6 billion people live outside the markets where standard payment infrastructure works. If your agent workflow touches any of those markets, you are either routing through informal channels or you are blocked entirely. Every payment account requires KYC. KYC was designed for humans. An AI agent has no date of birth, no government ID, no country of residence. The legal infrastructure for giving an agent a compliant financial identity does not exist in most jurisdictions. This means every agent that needs to transact is either operating under a human's financial identity, creating compliance exposure, or it is blocked from transacting at all. Fraud detection systems are trained on human spending patterns. Humans do not make 47 micropayments to API vendors between 2 a.m. and 4 a.m. Agents do. The result? The agent's account gets flagged, frozen, or rate limited precisely when it is operating most efficiently. One team running a data collection agent reported that their agent's payment account was frozen 17 times in 30 days. Each freeze required a human to call the bank, verify the account, and unfreeze it. The agent was doing its job perfectly. The infrastructure treated it as a criminal. Agents operating globally need to transact in local currencies. Converting USD to pay a contractor in Brazil costs between 2% and 4% per transaction in conversion fees and spread. For an agent executing 50 transactions per day across 10 currencies, that is a structural tax of thousands of dollars per month, just for the right to move money across borders. These 5 failure modes are not software bugs. They are architectural mismatches between infrast